Raj, before you start your business, we need to understand one of the most important concepts in corporate tax: how a corporation is treated.
Honestly, I don't even know what that means. Isn't my business just me?
That's true for a sole proprietorship, but once you incorporate, your business becomes a separate legal entity.
Separate? Like a different person?
Exactly. Your corporation is like its own person. It earns income, pays tax, owns assets, and you're just the shareholder.
So if my company makes $100,000, that's not my income?
Correct. That income belongs to the corporation. You only get taxed personally when you take money out.
How do I take money out then?
Usually through salary, dividends, or sometimes loans.
So I can't just transfer money to my account?
You can, but it must be recorded properly, or CRA will treat it as taxable income and penalize you.
Okay, so if the corporation is separate, does that protect me?
Yes, that's called the corporate veil. It protects your personal assets.
So if my business fails, I'm safe?
Usually yes, but there are exceptions.
Like what?
If you sign personal guarantees, commit fraud, don't pay GST or payroll taxes.
Wait, CRA can come after me personally?
Yes, especially for GST and payroll, they're considered trust funds.
That's scary.
It should be. Incorporation protects honest business, not careless behavior.
I keep hearing about CCPC. What is that?
Good question. A CCPC, Canadian Controlled Private Corporation, is the most common type of small business in Canada.
What makes a company a CCPC?
It must be private, not public, be controlled by Canadian residents,
Why is that important?
because CCPCs get huge tax benefits like lower tax rates, refundable taxes, special credits.
So if I incorporate, I want to be a CCPC?
Absolutely. That's where most tax advantages come from.
You mentioned lower tax rates. How does that work?
That's through the Small Business Deduction, SBD.
What does it do?
It reduces your corporate tax rate on business income.
Like how much?
Instead of paying around 26%, you might pay around 12%.
That's a big difference.
Exactly, but you must be a CCPC, earn active business income.
Does all income qualify?
No, investment income doesn't qualify.
Okay, but how do they even calculate that 12%?
It's built in layers.
Layers?
Yeah, base tax starts high. Then deductions like SBD reduce it.
So what's the final number?
In Ontario, federal 9%, provincial 3.2%, total 12.2%.
So on $100,000, I pay about $12,000?
Exactly. Without SBD, it would be around $26,000.
You said investment income doesn't qualify. Why?
Because tax law treats active and passive income differently.
What's the difference?
Active income equal running a business. Passive income equal earning from investments.
Like stocks or rental income?
Exactly.
And tax is different?
Very different. Active income around 12%. Passive income around 50%.
Whoa, why so high?
to prevent people from abusing corporations to avoid personal tax.
Wait, I'm confused. The corporation pays tax, then I pay tax again?
Yes, but the system is designed to balance that. It's called tax integration.
What does that mean?
It means total tax should be similar whether you earn income personally or through a corporation.
So I'm not being taxed twice unfairly?
Exactly. The system adjusts using dividend gross up, dividend tax credit.
Can you show me a real example?
Sure, let's say you earn $100,000.
Okay.
If earned through a corporation, corporation pays around $12,500. Remaining around $87,500 is paid to you as dividend. You pay around $41,000 personal tax. You keep about $46,000.
And if I earn personally?
You pay around $53,000 tax and keep about $46,000.
So it's almost the same?
Exactly, that's integration working.
Then what's the benefit of a corporation?
Timing, that's where tax deferral comes in.
What is tax deferral?
It means delaying personal tax.
How?
If you leave money in the corporation, you only pay around 12% tax. You don't pay personal tax yet.
So I keep more money inside?
Yes. Example, personal route. Around $50,000 left corporate route. Around $88,000 left.
That's huge.
That extra money can be invested used to grow the business.
So the benefit is timing, not savings?
Exactly.
And then I pay tax on that too?
Correct. That's the second level of tax. You report the dividend on your personal tax return and pay tax on it.
So it still sounds like I'm being taxed twice.
It looks that way, but here's the important part. The system is designed to balance this out. This concept is called tax integration.
What does integration actually do?
It adjusts things so that the total tax you pay ends up being roughly the same as if you had earned that income personally in the first place.
So whether I earn $100,000 personally or through a corporation, I end up in a similar position?
Exactly. The government doesn't want you to get a huge tax advantage just from incorporating. Instead, corporations give you flexibility and control.
So the benefit isn't really about paying less tax right away?
Right. The real benefit is in how and when you take the money out. That's where planning comes in.
Okay, that makes a lot more sense now.
Good. If you understand this flow, corporate tax first, then personal tax, you've got one of the most important concepts in corporate tax down.
Are tax rates always the same?
No, but corporate tax is generally flat, not progressive like personal tax.
What does that mean?
Same rate applies within a category.
What are the main rates?
Small business, around 12%. General rate, around 26.5%.
When does it go to 26%?
After $500,000 income or if you don't qualify for SBD.
Are all corporations the same?
No, there are different types.
Like what?
Main ones, CCPC, most common. Public corporations. Non-resident controlled corporations. Nonprofits.
Which one should I care about most?
CCPC, it gives you the best tax benefits.
What happens if it's classified wrong?
Your tax could double.
That sounds like a big mistake.
It is. That's why classification is critical in T2 returns.
Okay, Alan, this is starting to make sense, but it's a lot.
It is. But here's what you really need to remember. A corporation is separate from you. Tax happens in two stages. CCPC status is key. SPD gives major savings. Active versus passive income matters. Integration keeps tax fair. Tax deferral is the real advantage.
So corporate tax isn't just forms, it's strategy?
Exactly. Once you understand this, you stop being just a tax preparer and start thinking like an accountant and advisor